So we'll continue the discussion on high frequency trading and how to control risk in high frequency trading. So as we studied, these algorithms utilize the advantages of the advances in technology, mathematics, and high speed communications. Firms can trade in fractions of seconds. Computerized quantitative models are used to identify buy and sell opportunities in stocks, fixed income securities, and options. The models are also able to identify the price, quantity, timing, and the optimal location of the trades and any arbitrage opportunities that may exist between markets or between stocks. Sometimes called as black boxes, these systems read market data and transmit thousands of messages per second to exchanges to place, cancel, and replace orders based on market conditions. With virtually no human interventions, these black boxes, that is, these high frequency algorithms, are able to identify and capitalize on price discrepancies in the market. So, just some information, this trading in the equity markets grew from approximately 30% of the total volume in 2005 to about 70% in 2009. A mere 2% of the 20,000 US equity trading firms initiated this 70% of the volumes. So 70% of the trades in the US was done by just 2% of the firms which employed these high frequency algorithms. Let's talk about the importance of speed in high frequency trading. So stocks or securities are volatile, and traders who wish to buy or sell are exposed to risk in time that it takes for an order to get filled. So if it's a buy order, it takes some time before we find enough sellers. Similarly, if it's a sell order, it takes some time before we can find enough buyers. The faster one is able to act, that is, fill his order or complete the purchase or complete the sale, the less likely that he will have a price impact or the price will move up in the case of a buy order. So traders want to fill orders before the price of the asset moves in the opposite direction of the strategy. So that is why absolute speed of trading is very important. Relative speed is also important. That is, if one trader can act faster than the other, then there are more profit opportunities available. So if two algorithms both detect the same pattern, of course the one that executes it first is going to be the winner and will profit more. So in the world of HFT, the concept of latency is very important. That is the time it takes to execute the order. So this is latency, or delay is the time it takes for a person or a computer to recognize an event like a change in the bid-ask spread or any other information, act on the information, and have the exchange respond. So if the trader sees, for example, a bid-ask spread has widened, he'll place a sell order based on the information. The exchange will fill that order, and the trader who can complete this process with the least delay will have an advantage, or the algorithm who can do it at the least delay will have an advantage. So its latency is often measured in microseconds or 1/1,000,000th of a second. So that's the kind of speeds that we're talking about that these supercomputers or these programs today have. So they send orders to the exchange matching engine, a computer that operates on an order book, matching and executing orders. These traders want their orders executed first, reducing latency even by millions of seconds, allow these orders to be executed at lightning speed and beat the competition. So some customers of the clearing members and some non-clearing members send their orders directly to exchanges to increase the speed of trade execution. That is, they don't involve a broker in between, or they try to minimize the latency by cutting as many layers as they can. So what are the different methods to speed up trading? Exchange clearinghouse members are known as clearing members. These are the brokers and the clearinghouse members who accept orders on behalf of the exchange. So these clearinghouses will match and settle trades. Clearing members are also called brokers or dealers in the security market. And in the futures commissions, in the futures market in the US, they're called futures commission merchants. So non-clearing members are not members of the clearinghouse. They must clear the trades through a broker dealer or through some of these clearing members. So if I'm just a fund house, I'm a non-clearing member, so I'll have to trade through this broker or a clearing member. So these members are monitored by the clearing houses, and they are required to maintain a certain level of capital and put up margin for positions they maintain, just so that the market functions smoothly. There are no bankruptcies, there are no credit defaults, etc. So clearing members are also required to contribute to a loss sharing pool. In a sense, the clearing house attempts to mitigate the credit risk imposed by members, and clearing members must monitor customers and non-members to protect against the risks they pose to the clearing members. So the broker, if you give a buy order to a broker, essentially the broker will have some margin money of yours, or before he gives you back the money, he will ensure that you have transferred the shares. Similarly, if you've or rather the other way around, before giving you the shares, the clearinghouse will ensure that it takes your money. If it's a sell order, then before giving you the money, the clearing members will make sure that you have first deposited the securities, and only then the money is given to you. So this is why the market essentially works, and this is how the interests of the small investors and participants are protected. So that's the function of the clearing members, that is the brokers and dealers, who will match, that is first of all match the buyers and the buy and the sell orders, and then execute these trades and maintain some margin, maintain processes so that there is no credit default. Non-clearing members and the customers of the clearing members of these brokers can now send trades directly to exchanges via their own vendor provided trading platforms. So first, it can be done by a sponsored access. That is, this has some built-in pre-trade risk controls. So some margin is already deposited, etc. So essentially it just makes the process faster. So then the clearing member is not very worried, and with sponsored access, the traders or the non-clearing members can access the market a bit faster. Similarly, with unfiltered sponsored access, it's also known as naked access or direct market access in the future market. Again, the participants can go directly to the exchange and put in their orders very quickly, bypassing all these credit checks, etc. By getting a sponsored access or unsponsored or unfiltered sponsored access. Basically, the risk mitigation is done beforehand, and it's already settled with the clearing members. So with these methods, the non-clearing members can basically, or these high frequency traders can access the market much faster. So they are allowed to send orders to the exchange matching engine directly, and the risk is done already. So pre-trade risk control is already done. So limits on execution prices and order quantities, etc. are done in a sponsored access. In an unfiltered sponsored access, the provides the firm with direct access without any risk checks. So with naked access, there are no pre-trade risk controls. Trades are sent directly to the matching engine without any price or quantity limits. And HFTs prefer this unfiltered sponsored access because it is faster, because these risk controls and risk checks, etc. will often slow down the trades, because there is additional layer of checking that is going for before the orders can get executed and before the orders reach the exchange. So to reduce latency, first of all, speed is important. We started in the beginning. How do the programs get this high speed? They look for unfiltered sponsored access, or these firms will have very good relationships with the clearing members, so that the clearing member is able to provide them this unfiltered sponsored access, so they can execute faster than anyone else. Firms have found another way to reduce the latency, that is by moving their servers closer to the exchange's matching engine. So the closer the server is to the engine, the quicker will be the trade. And it is estimated that every 100 miles you get closer to the server, it equates to a 1 millisecond improvement in executing trades. Or every 100 mile that you go away, it will be a delay of 1 millisecond because of the time it takes the signal to transfer from your computer into the exchange's computer. So to reduce this delay, the exchanges are now offering co-location services. That is, the firms can place their servers in the building of the NYSE, or very, very close to the exchange of the, or very close to the server of the exchange. So locating close to the matching engine will reduce the latency, reduces the time it takes for the computer to access the central order book, This book holds electronic information on current prices along with the information on buy and sell quotes, and it reduces the time it takes to transmit your trade requests and to execute the matched trades, just because of the physical fact that you're closer to the electronic signal will transfer between your computer and the exchange's computer much faster. So market participants essentially can trade up their trading by locating close to the matching engine, that is taking advantage of the co-location services. Participants can also reduce latency by placing trades directly within the exchange using the unfiltered sponsored access that we studied in the previous slide. That is, the pre-trade risk controls, etc., can be bypassed and hence increasing the speed. Advantages and disadvantages of speed. So the rise in this high frequency trading was spurred by the decimalization of stock prices implemented in 2000. That is, the stock prices were coded in pennies instead of fractions of the dollar. So the smaller tick sizes caused a dramatic increase in the volume of market data. The additional information overwhelmed human capabilities for assimilation. However, computers were ideally suited to handle this avalanche of data, because now the information is in seconds, or rather in decimals. So you see that a 1 cent may not make a very big difference per se to a small volume of trade. For a $100 share or $100 trade, it may just mean $1. But you understand, for $100 million trade, it may mean a profit of $1 million, which is a lot. So this high frequency trading became very popular once these stock prices were decimalized. And the advantages of this high speed trading is the ability of the computers to assimilate mountains of data and capitalize on price discrepancies, narrower spreads which benefit everybody, the market is more efficient, increased liquidity also benefits everybody, and firms can quickly capture trading opportunities by use of this high frequency trading and these algorithms. Disadvantages of high frequency trading is the increased risks, as we studied, the systemic risks caused by co-location servers, unfiltered sponsored access. You understand that if these checks are being bypassed, then if a big trade goes wrong or a default happens on some big trade, then it can cause the whole system to potentially default, as every participant is nowadays linked to another participant in some way. So they increase the speed at which fraudulent trading also happens. So regular trading speed is increased, but so will be the speed of fraudulent trading and trading errors. So individual losses at times have amounted to hundreds of millions of dollars. Black boxes trade with other black boxes. So an algorithm trades with another algorithm. A mistake by one firm can impact the trading strategy of another firm. Regulators and other industry experts are concerned that one or more of these black boxes might go berserk, causing enormous losses. So according to one former deputy at the SEC, in the 2 minutes it takes for a broker dealer to receive information on a trade executed by a firm with unfiltered access, billions of dollars of trades can take place by these high speed or high frequency algorithms. So that's the extent of volumes today, and that's the extent of the mistakes also that can happen if they do. So that's some of the disadvantages that we should be careful about. Some noteworthy errors that we can talk about. In 2002, a sell order was placed by Bear Stearns for $4 billion instead of intended 4 million. So instead of 4 million, 4 billion is what was placed, and the Dow Jones dropped 100 points. Similarly, in 2007, there was a Morgan Stanley error. MF Global removed pre-trade risk controls, leading to $141.5 million loss. So you don't have to remember these, but they're given in your notes, so you can just see the problem of this high frequency trading. So wrong orders will also get quickly transmitted and can cause big crashes in the market or big problems or big losses for individuals. So generally, to manage risk in the markets, we have pre-trade risk controls as well as post-trade risk controls. So again, the goal of the risk controls is to prevent unintentional or avoidable losses. So volume controls stop trades after they exceed a certain size. price limits stop trades outside a predetermined price range, the trade will not happen. Trade bust policies cancel obviously incorrect or erroneous orders. So if it's a very large $4 billion order, for instance, it will automatically cancel because it knows that the firm's trading volume is generally in the range of $1 to $10 million. So a $1 billion order will automatically get cancelled. Risk controls imposed by clearing houses, that is, you have to deposit some margin money before you can trade. So even if you have a loss, that margin money can be used so that there is no credit event and no systemic risk. Broker dealers and futures capital market participants will verify the risk controls of customers and non-clearing members, again normally by doing a background check, know your customer, capital requirements, etc. Some exchanges also have post-trade risk controls, so they often provide real-time information on the customer's trade so that they can act in the event of an erroneous trade or a fraudulent order. So they can use the information to determine whether to allow customers with unfiltered sponsored access to continue trading or not if they see some actions of manipulation or continuous errors. Some exchanges also provide means to automatically stop trades. So this is also a risk mitigation tool that needs to be implemented so that trading can be halted quickly in case of a significant error is realized or significant erroneous order is put in place. So these are some ways of controlling the risks in this high frequency environment or high frequency trading.